The Hong Kong market, that's down around 66 points.
Support comes in at the lows of 19,914.
Felt that it was very important to bring someone like Peter who can pull it all together.
First tick on the index, down about 130 points, slipped below that 20,000 mark.
I don't see it derailing the trajectory for the Indian economy over the short to medium term.
There is a lot of, I would say irrational exuberance in these small cap PSU banks.
Because our expansion, our machines are coming, and we all know that today there is a shortage of chips.
Clearly a down day, right, for our markets. And there are two culprits. One is HDFC Bank and the other one is Reliance Industries.
We are in a fairly comfortable leverage position, but listing is giving us an opportunity to improve the cap structure.
The key takeaways is that there will be a decline in net interest margins on total assets by as much as 30 to 40 basis points.
I think the amount of competition has not come down, but I do see that price as a basis of competition has come down.
The difference is that Air Fiber will use the high-speed 5G technology to provide you connectivity.
The UPA bill did not have a delimitation exercise clause and implementation of this bill after the census is done.
From the day's highs, the fall is about 126 points, and at no point in the day have we seen any kind of respite in the market.
Well, there is no respite still. You're with us here on a fresh new edition of Closing Well. We are coming to you live from the CNBC-TV18 News Online studios, and I'm Prashant. With me, my colleagues Rima and Nigel. Guys, hi, good afternoon.
Hi, good afternoon. 19,900, and it went also.
Yeah, it went also, and we were just, I think, under that level. Just a couple of points. I mean, so we are on the Nifty trading pretty close to, the second downward level that we put out in the morning, which is 19,914. So a close will be important. Hopefully there will be a bounce, and then perhaps this is defended. Even if it is a close under it, perhaps hopefully not, way under it. Similar level on the Nifty Bank, which, by the way, is still holding above the levels that we put out in the morning, 45,299. We're at 45,355. Again, about 50, 60 points. Anything can happen in the next 60 minutes. Mid-caps and small caps, like Monday, again taking a bit of a breather, down between 0.5% and 1%. I want to go into details, I think, well discussed and dissected. It's a breather. I mean, one can read a fair bit into it because there's, oil going on at very high levels, 95-ish. Dollar index, which is strong. There is the Fed decision later after market hours, which hopefully will be a non-event when we come back in the morning. So those are, some worries. They've been worries for a while, but that's markets for you, right? I mean, they decide and choose and pick a time and spot when they want to sit up and take notice. So that's what's going on at this point in time. Rima.
Hi, it's like twin blasts have hit the markets, right? HDFC Bank. We knew HDFC Bank is going to be weak after the analysts made the outlook on the net interest margins, but then came Reliance Industries, and both of them together have resulted in a big fall on the market. So their combined weight of Reliance and HDFC Bank on the Nifty is close to about 24%, right? Close to about 14% for HDFC Bank and about 9-10% for Reliance Industries. And together, they've resulted in a loss of 140 points on the Nifty. Now, here's the thing. At 11 o'clock, when I checked the statistic, it was HDFC Bank and Reliance together was contributing 85% to the Nifty fall. So it was largely just these two, stocks. The rest of the market was holding up pretty okay. But now HDFC Bank and Reliance is resulting in 60% of the Nifty fall, which basically means in the last 2-3 hours, the rest of the market too has started selling off. The Nifty PSU Banking Index for the first time is seeing a correction of over 1% after a long time. The Nifty Metal Index is weak in trade. Look at the mid-cap index too. The small cap index in itself has a cut of close to about 1% or more than that. The gap between the advances and the declining stocks has also widened quite considerably just in the last maybe 1 hour or so. The advanced decline will come up for you on your screen. The big losers, we spoke about HDFC Bank, Reliance, but other than that, you've got a JSW Steel, you've got a State Bank of SBI Life, Dr. Reddy's, Ultratech Cement, Britannia, Bharti, and the list of the losers other than those two are also quite large now.
Well, Rima, just one point I want to make on HDFC Bank. It broke the 20 DMA earlier today, and now it is just 20 rupees away from the 200 DMA. The 200 DMA is at around 1,550. So I'll be watching that marker on the lower end. The day's low today is 1,560. So that's an important point. The 200 DMA will be a crucial technical level that the bulls will want to defend on HDFC Bank. Now we have our hands full because the next 60 minutes you'll have the Nifty Bank that will be playing out expiry. And there has been aggressive writing that we are seeing on the call side today. Just to pull up one of the most active strikes today, the 45,500 call. The open interest build-up is 1.5 crore shares, big time. And just take a look at the premium. That's down from around 530 rupees to around 5 rupees. So that's 99% lower. Aggressive writing is what we have seen at that particular level. On the option side as well, on the put side, you're seeing aggressive, build-up at around this strike. That's a 45,300 put odd. The bulls would like to defend this mark on a closing basis. So those are the most active strikes out there. The call writers, they'll be feeling very, very good. Do we have a twist in the tail in the final 60 minutes as we play out expiry? Can the markets bounce from here? Well, then these call writers will get stuck on the wrong side. So let's see how this goes. 45,500, that's the crucial mark you're looking at. Well, how do you position yourself, though, in the final hour of trade? Mitesh Thakkar is back with us. Mitesh, what's your take? The Nifty Bank is looking a little bit weakish. It's underperformed a little bit today, quite a bit, actually. Your view on the Nifty and the Nifty Bank?
So, good afternoon, Rajan. Earlier in the day, I was talking about the fact that trading below 20,050 on the Nifty would invite buying some put options. We've done that. It still doesn't look like a full-fledged declining trend, but it looks like a slightly severe correction. And I think we could possibly even test 19,800 levels or 19,770, that support zone on the index. And similarly on the bank Nifty, the corresponding levels are closer to about 45,000 to about 44,900. So I think there is some more downside left. It will be choppy, it will be volatile. And, the worry is that in case those levels start breaking, then I'll, look at aggressive shorting as well. But for the time being, we're trading with the mixed bias on the stock side. We have slightly, more exposure on the short side, but it's a mix of long and short. So right now also I have one buy and one sell call. PI Industries, I think that's the stock which is breaking down. So that's a sell with a stop at 35.50 for targets of around 3,400. While Polycaps is something which has made a fresh high, it's still looking strong and is outperforming. So that's a buy with a stop at 52.30 for targets of 5,400.
Mitesh, in the morning on, I think we spoke about PSU, public sector banks, and you were saying that at lower levels, I think you'd buy. But today, again, I think we've seen sharp reversals, right, on some of these individual names from day highs. What's the sense there?
Prashant, I think the PSU banks, they've also declined a little bit. And while the Nifty PSU bank index is down %, which is as good as Nifty, I think I would still wait it out. I think I'm looking at the Nifty PSU bank index 1, which is at 51.50 right now, to come down to 50.50. And in the worst case scenario, I think, even 4,900 to about 48.75. In case I get entry around those levels, it'll be very good because the last rally itself saw the PSU bank index rally from sub 4,500 to about 52.50. So 300, 350 point kind of a pullback, which is 38.2%, is very likely on the PSU bank index as well. It remains an outperformer, so I would still be wanting to buy it, but still slightly more lower levels.
Okay. Got that. I mean, we were pointing out in the morning that volumes there on Monday were some of the highest in a long time. And, last 3 years, 2 to 3 years, that's not been a good sign. It's basically signaled a bit of a top there, but, we'll see. HDFC Bank now, Mitesh, thanks very much. We'll come back to you. But staying with financials, HDFC Bank, which we were talking about earlier, is the top loser. It's, of course, adding the most amount of pressure on the downside as well. Analysts meet on Monday, and some things came out which the markets did not like. Abhishek is here with the key takeaways. Abhishek.
Well, HDFC Bank held the analyst meet on Monday post-market hours. Now, it shared details with respect to pro forma merged numbers of the lender along with the numbers of HDFC Limited. The key takeaways is that there will be a decline in net interest margins on total assets by as much as 30 to 40 basis points to about 3.7% to 3.8% from the 4.1% net interest margin on assets that was recorded in Q1 FY24. Now, the cost-to-income ratio stabilization is lower than street anticipation, and this is due to accounting methodology changes that is there. So management has said that the cost to income ratio will decline to 40% versus 43% that they had in Q1 FY24. So the return ratios on account of decline in net interest margin will decline to about 1.9% to 2% from the 2.1% that the bank recorded in Q1 FY24, while the ROE, that is return on equity, is seen around the 16% level from 17.2% that the bank did in Q1 FY24. So capital adequacy ratio will increase to about 19.2% from 18.9% that was recorded in Q1 of FY24. The key negative surprise has come in the form of asset quality of SDFC Limited, the non-individual segment. So the individual segment gross NPA ratio has increased to about 1% versus 0.75% at the end of March 2023, while the non-individual gross NPA ratio has actually spiked up to 6.7% from 2.9% that was there as of FY23. We have Nomura's estimate on post-merger for SDFC Bank versus the numbers that they have recorded or they have estimated for ICICI Bank and Axis Bank for FY24. So Nomura estimates a decline in net interest margin for SDFC Bank by 30 basis points to about 3.5%. Now they are estimating ICICI Bank's net interest margin to be at around 4.6%, and Axis Bank net interest margin is seen at 3.84%. Hence, on net interest margin, SDFC Bank will underperform the peers for FY24 as per Nomura's estimate. Now, Nomura also estimates the cost to income ratio to increase for SDFC Bank to about 40.1% from 37.5% that they had estimated earlier. Now, this is better than peers, wherein ICICI Bank's number is estimated to be around 40.4% for FY24, and Axis Bank is seen around 47.2% for FY24. Return on asset of SDFC Bank for FY24 has been trimmed down to about 1.7% from 1.9% that they had estimated earlier. For ICICI Bank, Nomura estimates ROA to be better than that of SDFC Bank, about 2.2%, and for Axis Bank, they have the same level of SDFC Bank at about 1.7%. However, the key difference is the ROE profile versus peer for SDFC Bank. So peers will have better ROE profile than SDFC Bank for FY24. Nomura estimates the ROE of SDFC Bank to come down to about 14.2% versus 15% earlier, versus 17.7% that they have estimated for ICICI Bank and about 18.1% that they have estimated for Axis Bank for FY24. So in terms of valuations, based on the book value estimate of Nomura for the three lenders, SDFC Bank is now trading at a price to book value based on FY24 numbers at 2.6x, while ICICI Bank is trading at 3x and Axis Bank is trading at 2.2x. Momentum on net interest margin and return ratios for FY24 of SDFC Bank versus peers like ICICI Bank and Axis Bank may be on investors' radar, and hence valuation changes may be closely watched by the investors.
Abhishek, thank you very much for that. Let's once again pull up that valuation plate. HDFC Bank, if you remember, used to command premium valuations. Its price to book used to be more than 4x higher than peers, and now it's come down to 2.6, 4.1, 4.2 also for HDFC Bank, and now its valuation is lower than that of ICICI Bank. Prakash, it's quite a derating that HDFC Bank has seen in its valuations. Where does it go from here on?
So first and foremost, I don't think there's anything new in this or unknown in this, right? This was anticipated. It's just that it's got articulated by the management on the last weekend. And certainly everybody's taken notice of it in very sharper terms. The articulation of what was expected in numbers is a very good step in terms of managing expectations going forward. Because remember, these are two big businesses that have come together. And my thesis is HDFC Bank was primarily a fee generating machine, along with, of course, a fund-based activity, whereas HDFC Limited, which is now part of the same house, was a purely fund-based activity. So the margins will take some time to reset. Nobody's talking yet about the kind of increase in revenue potential, the growth rates that they can manage with this thing, the softer cost of funds. So all of those advantages will start balancing out some of the weaknesses that the merger has brought about. So I think it's a great opportunity for long-term investors to add something like this in their portfolio. It is a re-rating for sure, given the softness in numbers, but it's not far off from what Axis went through when they acquired Citi, right? Unfortunately or fortunately, Citi was a unlisted business. That's why you weren't able to see the impact which you are seeing in HDFC Limited and the bank. So I think it's very clear. The price to book, which is a big parameter of how fancy the stock is, of what the market is willing to accord to it, will probably go back to its 3.5, 4 zones at some point in time, given the strength in the economy and their ability to ride on that. So I think it's just a point in time at which it's looking soft. It could probably lose some more ground, but there will be enough takers, largely ETFs and large institutions, who would want to buy into this at this value.
So under pressure today, HDFC Bank, but could be a good stock to have in your portfolio if you have a longer term horizon. Thanks for that, Prakash. I wanted to ask you about a couple of these power finance companies, as there's been a big run up in the power sector, and one of the beneficiaries in this run up has been REC. The green energy push by the government seems to be working for the power sector, and REC has set a target of 3 lakh crore rupees by FY 30. To discuss this, we earlier spoke to Mr. Joy Chaudhary, the Director of Finance at REC. Let's listen into what he had to tell us in terms of an AUM growth that they're targeting for this year, as well as the outlook on NIMs.
On the power segment, there will be a competition, definitely, as the power sector improves. And so we are up to it. But there is so much of requirement in the power sector, at least till 2030, when this transition thing is happening. So we don't see, that our growth will in any way come down because of the competition. But we are mindful of the competition that will come in the power sector because of the improvements that's taking place. We look at the asset quality. In fact, you see a slight dip in the margins precisely because we are conscious of the asset quality. So this year we hope to resolve around 7,000 crores. That will be around 40-45% of our stress assets we wish to resolve. And once we do that, in the next year, we want to completely clean our balance sheet. And we certainly don't want to add any more NPAs. It's been 6 quarters that we have not added any NPA. And we'd like to go like that only.
All right, Prakash, what do you make of this one? It's been moving up. It's doubled in this year itself, REC. Management saying AUM growth this year, they're looking at 15%. I've got some feedback. People say that it'll be at least 15% going by what they've done. So let's see what they do on that front. The NIMs were a worry, which are at 3.3%. They're saying that they can go to 3.5% because borrowing cost itself will reduce by 15 basis points or thereabouts, and they've increased their yield a little bit. And they're talking about resolution of close to around 7,000 crores. What do you make of the stock? Missed the bus, or do you think someone can still jump on at 250?
Oh, I don't think you missed the bus in this case. What has happened on the stock? Of course, a little bit of a premium today that comes is because of the nature of the business, the PSC pedigree, and the dividend yield and all of that in the early stages of this rise. But if you look at it from a 3-year perspective, where is it headed? 7,000 crores coming back from stressed assets is a great change in the complexion of the balance sheet. And if they continue to have this no new NP accretion way beyond the 6 quarters that he spoke about, you have a growth engine that is immensely powerful. Remember, we are talking about a margin improvement of 30 basis points, which is likely. And for the same 30 basis point, HDFC is getting beaten down. The loss in margin NIMs. And here we are saying this could improve. So, the market can accord very, very different kind of, premium valuations to businesses that have clear visibility and growth. Given the fact that they are the only ones who have experience in managing, lending to this sector, and if green energy is something which is seeing so much of capex coming in, so thermal is not seeing that kind of happening. But if solar and wind and all the renewable segment start seeing so much of growth, they have the luxury of picking and choosing what they want to lend to, where they want to add to. And that will probably help them grow the AUM in a far more convincing way than just that 15% we spoke about. So I'm very positive on this. Yes, but I would definitely recommend if you lost out on the opportunity earlier, you'd probably wait for some time. And there are days when you see a little bit of a setback where some news flow brings it back to a little bit of a reasonable valuation zone, and that's when you can definitely add. But I don't see the story stopping for the next 3 years for sure.
Okay, stay on, Prakash. Need to slip into a break. On the other side, we'll invite our alpha manager for the day, Tridib Bhattacharya of Edelweiss AMC. Stay tuned. Welcome back. The Nifty is around 19,900, but in the broader markets, names like SCI. SCI has moved up 3.5%, very large volumes. Suzlon Energy, a stock which has been on fire, 140% higher for this year. But today, Suzlon Energy, after a slow start, has suddenly perked up in trade, 3% gain on that. And Indiabulls Real Estate, very, very large volumes, and the stock price is moving up 1.5%. But let's turn our attention now to the primary market. We've seen IPOs of two companies, Sensex and Signature Global. Signature Global is a real estate company predominantly based in North. Both these IPOs have opened for subscription today. Surbhi is here with the details. Surbhi.
Thanks so much for that. So let me start with Sensex first. As you said, it's open. The IPO opens today. The price band is set at 210 to 222 rupees per share. They are looking to raise 1,200 crores, of which 600 crores will be fresh issue and 600 crores will be offer for sale. The implied market cap comes to 3,400 odd crores. Now, Sensex is among the top 10 ethnic apparel players, which is focused on saris and predominantly south of India. 68% of their revenues comes from saris. They operate through 4 large store formats: Kala Mandir, Varamahalakshmi Mandir and KLM Fashion Mall, which basically caters to all price points. They have presence in the online market as well. Currently 1.37% odd comes from the e-commerce segment. And the next one which is on my radar is Signature Global. As you said, it's an NCR based real estate player. It focuses on affordable and mid-income housing segment. Their price band is set at 366 to 385 rupees per share. The IPO size is 730 crores. 600 crores is fresh issue, 127 crores is the offer for sale. The market cap comes to 5,400 odd crores. Now most of the money is going to use towards repayment of debt, but a part of the money will also be used for land acquisitions and some inorganic growth. We spoke to the management earlier. They said that currently the gross debt is 1,700 and net debt is 1,100. Post the IPO, debt to equity ratio will be 1:1. They have 17 million square feet of land which is under various stages of completion, and they have an unsold inventory of 4,000 crores as of FY23.
Okay, thank you very much for that. By the way, Signature Global also has been reporting losses for the last 2 years, and its net worth too was negative for FY21, FY22. But Surbhi, RR Kabul listed today. It's had a steady debut on the exchanges. You heard the management speak. You've been poring over the company's financials. Take us through more details.
So RR Kabul, it was a strong listing, and that was expected because the subscription was over 19 times. Now most of the money that they have raised is an offer for sale. So TPG's stake has come down from 16% to 5% post the IPO. Now it's a wires and cables company with the presence in FMEG space as well. They have 7% market share in the cables and wires space. Around 90% of their revenues comes from wires and cables, of which 70% is wires and 30% is cables, and that's where it's different from Polycab, because Polycab is largely into the cable space. 11% of their revenues comes from the FMEG space. The other differentiation in this company is that 74% of the revenues comes from the B2C channel. So they have a strong presence in the B2C space as well. When you look at the financials, they're pretty strong. In the last 3 years, the compounded revenue growth rate was over 30%. EBITDA and PAT both have grown at over 15% compounded rate. When you compare it to the peers, it's more comparable to the likes of Finolex and KEI, because RR Kabel's revenue is 5,500 odd crores, and Finolex and KEI both are in the range of 4,000 and 7,000 respectively. On the margin front, it is the lowest amongst the peers. It is at 6% EBITDA margins for FY23, whereas the others are at 7% and 10%, and that is largely because it has more exposure to the wires segment, which has lesser margins when you compare it to the cables. Now, when you look at the valuations, FY24 basis, it is trading at close to 50 times FY24 PE, which is similar to the Polycab levels. We have spoken to the management, and they said that they have a planned capex of 500 crores, of which 150 crores will be done in FY23, 350 crores in FY24, and the asset turn on this capex will be close to 5 times. They can do 7,000 of revenues with the existing capacity itself, and they're also looking to increase their presence in the export market.
All right, Surbhi, thanks very much for that. So that is RR Kabul with that debut out there. So Monday we had a decent, very good listing. Jupiter Life Hospital made its debut. Beg your pardon. Today you have RR Kabul, and of course, I mean, the primary market pipeline is very, very strong. Prakash, any thoughts on these two names? You know, one thing we've seen, stocks which on day one, actually it's true historically as well. I remember, a few years back, I looked at data going back 20 years. Day one big pops tend to be wealth creators over a period of time. Of course, there are exceptions as well. I think Nykaa comes to my mind, but it's more the rule than the exception. More the exception than the rule in the case of Nykaa. But these two, if you looked at it, the hospital company and the cable company, any thoughts?
Yeah, so I think let me speak about RR Kabel because that's something which is in a very hot and as I said the other electrifying space. But I wouldn't, 15-16% is fair enough given the fact that there was so much of demand for it on that oversubscription numbers tell you. But 55, 56 times FY24 with just this margin profile, would you be willing to pay for it? The question is yes, if you don't have better options. So, this is a space where you could have made money when this space was getting discovered of sorts, with Polycab kind of leading the charge. And even now, if you see what Surbi was sharing, the likes of Finolex still offer you great opportunity from a value perspective. Of course, they have their own share of issues, focus from the family, all of that is yet to kind of get established irrevocably. But if could probably give you a very significant upside, given that it's still trading below 25 times FY24. So I would prefer doing that and let RR Kabel enjoy the listing and the post-listing phase. But you need to look at that. And I'm not a big fan of companies which come up with OFSs, so which help somebody else get an exit at these kind of levels. So I would wait for it to get a bit more consolidated and look at something else.
Okay. By the way, you gave a look to Sai Silks. Prakash?
Yeah.
We had them with us earlier.
Yes, yeah. I heard Nigel and Sonia and you talking to them, and very impressive. Everything they spoke seemed very right, a bit too right actually. But this business is not as easy. The kind of competition from the unorganized sector is immense. We've seen how some of the likes of businesses that have actually shut shop in spite of being very large and well networked. So exciting to hear, but whether you want to put money behind something like this at this stage is a little bit of a thing. And it's not at a very high market cap, so there is room. But let me understand the business after a couple of quarters. Maybe I'll be better equipped to talk about that.
Buy sample a few products, Prakash.
I'll go by advice. Yeah.
I think Nigel is the one who's excited. So I think we'll ask Nigel.
Prakash, normally you know how excited I am whenever the new management comes in here. But Sonia and Prashant were just taking it on board. I couldn't pronounce the names of some of those saris, but these guys were full flow. Prashant, post the interaction, was doing some inquiries.
We have 3 people here in the studio. There's only one who wears a sari. So Rima's
but Nigel, let me explain. Prashant has the advantage of his geographical pedigree.
That's true.
Of course, Sonia had the gender support, so it made a lot of sense. And of course, we were as sharp as ever. So lovely interaction. Thanks.
So, Prakash almost made it sound like a full strategy going on, right? To interview the
Nigel does the numbers, Sonia does the product.
All right, Prakash. Thank you very much. Great speaking with you. It's a pleasure and good chat as always. Our Alpha Manager of the Day is with us, Sudeep Bhattacharya, Chief Investment Officer at Edelweiss Asset Management Company. It's really good to have you with us here. Thank you very much for your time. You're broadly saying that markets seem to be 10-15% more expensive now, right? And that is a sentiment one is hearing more and more. I was reading a note written by one of a PMS manager, basically saying, is this time different? And kind of, again, going back to whether we should be sort of accounting for higher valuations and what should be the reason. So there's a real kind of dilemma going on, a debate going on. The point is, what should one do? I mean, for example, you and your fund don't take any cash calls, so you largely stay invested, right? So you got to move away from very high valuation companies to relatively lower down the curve, at least in terms of valuations. How easy is that right now?
So basically, 2 parts to the portfolio adjustment. One is adjust the stock picking in such a way that we go to lower rung of valuations or lower valuations within the same area, but yet not take a too big a deep dive or too deep a cut on the quality of the company that you are betting on. So that's one way, one adjustment that we have done of late. Second is in funds where we can take a call across market caps where we want to be. Our portfolio allocation towards maybe the large cap or mid-cap has probably gone up a little, a spectrum, as opposed to the mid and small segment. So, I mean, we're certainly saying that it's time for taking a more balanced approach as opposed to kind of taking a mid or small cap centric approach, because in some pockets we are seeing valuations which are on the higher side, which are best avoided. So two parts to it. One is within the same theme, same area, same sector, shift to a lower valuation stock without taking too much of a knock on the quality of the company. And second, go slightly higher up on the market cap chain. These are the two bits that I would say. Nothing is easy, of course, but that's the attempt.
Trideep, afternoon. I believe in your Flexi Cap fund, you all hold HDFC Bank quite prominently. What have you made of the recent comments by the management, the way the stock has reacted to the analyst meet, and what's come out of it? Does it worry you?
So, I mean, not in the medium term standpoint. I think the risk coverage is probably higher, or needed is higher than what we had anticipated, and you are seeing the reaction to the name. But it is not diluted so much that one gets worried about the portfolio quality over a period of time. While we hold HDFC, one of the leading banks that you mentioned, but our active position in that is kind of fairly limited. So overall, we are mindful that as the company goes through the process of merger, some of these things will have to be ironed out over the next couple of quarters, and then the synergy benefits will flow through. But we see that more as a transient impact rather than any long-standing quality issue with regards to the book that they operate with.
You said you hold the stock, but the active exposure is quite low.
Yes,
what does
that's
that
what I
mean?
meant. So active exposure, we can't get stock specifics, but when we say in general active weight is lower, it means that it has a certain weightage in the index. So vis-a-vis the weightage in the index, the weightage held in the portfolio might not be too different.
Okay.
Trideep, the last time you were kind enough to share with us a couple of sectors where you're bullish on and where you added, I think, EMS, hardware-oriented companies as well. I think, you added a little bit, and you perked up a little bit of exposure to pharma and IT. What's changed now? Have you lightened positions firstly in any sector?
Yes, so overall, with regards to global cyclicals, is an area is an area that we've taken advantage of the little bit of a buoyancy that we've seen of late to sort of cut our exposure to a certain extent. We have, as I was saying, that some of the higher valuation stocks we have cut our exposure to, rather than switching around the sectors. Within the sector, we have taken a bit of a haircut with regards to higher valuation names and moved on to the ones which are lower on the valuation spectrum, with markets where they are. Profit booking in one spectrum at the more expensive end and moving to the lower valuation end is what we have done. Our themes or the sectors that we are bullish on haven't changed too much. Incrementally, though, over the last 3 to 6 months, we have incrementally added towards IT whenever it has presented itself an opportunity, and that's so far worked out well, and we'll see going forward.
Trideep, we leave the conversation here for now. Thank you very much for joining in. Like we've been saying, the big event today is going to be the U.S. Federal Reserve's 2-day policy meeting. It's begun, and the outcome will be known at 11:30 p.m. Tonight. The unanimous expectation appears to be the central bank is likely to skip a rate hike this time. In fact, majority of the respondents in a CNBC survey expect the Fed to leave rates unchanged. CNBC's Steve Leisman gets us up to speed.
While there remains debate, respondents to the CNBC Fed survey generally believe the Fed is likely done hiking rates and is about to embark on an extended period of holding rates above 5%. Here are the Fed expectations from the CNBC Fed survey of 30 respondents. 93% say the Fed leaves rates unchanged this week. Then there's this debate, 63-37 hold versus hike in the November meeting, which almost exactly mirrors where the market, the futures market, is priced. Then they hold on for 9.7 months, call it 10 months, where the Fed will hold at that peak rate. And then the debate about a cut comes in June, where the first plurality is 49-45 in the month of June of 2024 for an actual cut. John Riding from Green Capital says this is a meeting where the Fed should clearly transition the message from how high rates are going to go to how long are they going to stay there. Now let's look. We have the inflation rate, the funds rate goes up. You see there that 5.5%. That reflects the some percentage of folks who thinks there's one more cut in there. But then you see that the inflation rate comes down. It means the real rate doesn't move. So the result is the Fed maintains a highly restrictive rate for some time, or a highly restrictive real rate for some time. Robert Fry, an economist, writes, with an auto workers strike, the resumption of student loan repayments, the exhaustion of excess savings, a possible government shutdown, and gasoline prices approaching $4 a gallon, we could go very rapidly from strong growth in the third quarter to declining economic activity in the fourth quarter. The trouble for the Fed and economists has been the unexpected strength of the economy so far made it difficult to game out where policy should go. So we asked folks, what mistakes have you been making over the past year? And you can see here, look at the percentage who underestimated the strength of the strength of the labor market, 69%. 59% underestimated the strength of consumer spending, 59% government spending. Then there were those excess household savings, lots of reasons to get things wrong. They think they had the inflation dynamic more or less right, but 11% underestimated the impact of Fed rate hikes, while 50% thought they would be stronger, or they overestimated the impact of those rates. Now, 67% of respondents think that the lagged effects of tighter monetary policy are still to hit the economy in the months ahead. So the Fed may be on hold, but it's still going to be having a profound effect on the economy, and the economy may force it to adjust policy, so it can't necessarily just, put its feet up.
Welcome back. Well, a few stocks should come up for you on the screen. Alembic Pharma, I remember that stock was doing quite well this morning. It's suddenly seen a sharp dive in the last few minutes, so that should come up. And Dr. Reddy's as well. So a couple of these pharma names, they are seeing some bit of selling, particularly in the last 10 minutes or so. Big drop is what we're seeing on Alembic Pharma. Dr. Reddy's as well moving lower. But it's that time of the day when Nimesh joins us to tell us what he's picking up in D-Street Chatter. Nimesh, what's your sense?
Hi, Nigel. An interesting day of trade at day's low, largely dragged by the large caps like HDFC Bank and Reliance. But again, the feedback is today there is basket buying and also there is a market at close FI flow at a leading FI. So contrary to the screen, the flows seems to be quite positive and quite active as well. A lot of funds seems to be active in terms of activity today. So the volumes are on the higher side. Again, the broader markets are relatively outperforming and doesn't look like there is a panic selling yet in the broader markets. Of course, the Nifty looks weak, largely on the back of the large cap names. The FOMC outcome will be important event to track today. But if you remember on Monday, I highlighted about possible fundraising via QIP. You saw what happened to Blue Star today, up 13% after the QIP announcement. I guess a couple of more QIPs are lined up for this week. I'll address one of them in the chatter as well. But broadly, while the screen looks weak, there is flow which is positive, and there is a MOC buying as well at a leading FI desk.
Okay, all right. Nimesh, you said you'll address one of those stocks in your chatter list, so let's go straight to that.
Well, Nigel, the first stock is Sheela Foam. I spoke about the trend of QIP fundraising. Looks like the QIP for Sheela Foam is round the corner. It should happen very soon. That's the general indication, and hence a bit of outperformance as well. This week the stock is up 6%, so watch out for that. So that's the first one. The second stock is Bharti Airtel. Looks like some institutional interest is back on that stock. For the last couple of days, the feedback is there is buying interest back from larger FIs. And even in today's trade, the volumes are on the higher side, and there are buy flows as well. So that's Bharti Airtel. The third stock is Tarsen Products. There's a large block, nearly 3% equity got changed hands today. Not sure on the exact details, but looks like an FI investor was a seller in today's block. So the disclosures could be quite interesting in that particular name. And the last stock is Polycab, a big mover in today's trade, up 3% But contrary to the move, I understand there are sell flows at a leading FI desk. So again, contrary to the screen, there is selling pressure in Polycab, is what I understand from leading FIs.
Okay, Sheela Foam, Bharti, Tarsans, Polycab. Interesting list as always. Nimesh, thanks very much for that. What to buy or sell today for a reverse trade when we come back tomorrow? Mitesh is back with us for that. Mitesh, what do you have?
From the EU Bank on the BTSC side, keep a stop at 749. Look for targets of 765, maybe 770 on the upside. While most of the other stocks are trending negatively, so I'll have one STBT call as well, and that's on Go4, which I would recommend taking your STBT position with the stop just above 54.80. It may be a one-day sell kind of position as well because the stop is slightly deep. So 54.80 and 5,300 as the target area.
Okay, Mitesh, thanks very much for that. Now let's address another important news story. Reliance Jio has launched Jio Air Fiber services in 8 metro cities on Tuesday, which will cater to the home entertainment, smart home appliances and high-speed broadband segments. Rima is here with a detailed rundown on what this announcement could mean for you and me, the consumer, and of course for the customer, for the company as well. Rima, tell us more.
Thanks so much for that. So let me start by explaining what exactly is an air fiber. It's a broadband offering, which means you get Wi-Fi at home, but instead of the signal coming to you via the optic fiber and cable, this is wireless. Think of it as a Wi-Fi hotspot or a router. The difference is here you get connectivity via high-speed 5G technology instead of your optic fiber. So all you need to do is purchase the Jio Air Fiber unit, place it at a convenient spot in your house, plug it in and turn it on. It's also portable. Now, if you remember, the Ambanis had announced it in their AGM that they will be launching Jio Air Fiber on the 19th of September. That's yesterday on the auspicious occasion of Ganesh Chaturthi. But at that time, they did not disclose the pricing. It's the pricing which was disclosed yesterday. Now, Jio Air Fiber comes in 3 basic plans. The entry-level plan is for 599 rupees, where you get 30 Mbps speed, 550 plus digital channels, and 14 apps. You go higher up, then you've got 899, where the speed is higher at 100 Mbps. And the most expensive plan is 1,199, where you have other OTT apps like Netflix, Amazon Prime, etc. These are the Jio AirFiber Max plans, and these are the more expensive ones. They start at 1,499, and then for higher speeds, the monthly plan goes up to 2,499, and even as expensive as 3,999. Now, if you remember, Bharti Airtel too has commenced a trial of its fixed wireless access, a very similar product, but it's a trial which is currently only in Delhi and Mumbai. Bharti is right now offering you only one plan. It's a monthly tariff of $799. So let's quickly compare Bharti and Reliance Jio. For the same speed of 100 Mbps, Jio is going to charge you $899. Which is more expensive than Bharti's $799. But with Jio's ₹899 plan, you get 14 apps, which includes Disney Hotstar, Sony Live, Z5, but it doesn't include Amazon Prime, Netflix, and you also have those 550 channels. Also, Bharti Airtel will take a security deposit of $2,500. In the case of Jio, there is no security deposit. In fact, you get a Wi-Fi router, set-top box, and a remote fee, but there will be an installation fee of 1,000 rupees unless you take an annual subscription plan. And the other big difference is, remember, the Jio AirFiber is right now in official launch. It's gone live in 8 cities, but for Bharti, this is still in trial stage. They're currently running only pilot projects. Now let's get back to what this means for Reliance Jio. Well, from Jio AirFiber, Jio is targeting an addressable market of 200 million homes, which means they're hoping 200 million homes will be using Jio Wi-Fi, either via the optic fiber or via the wireless route. But according to analysts, this target of 200 million homes could be a tad bit aggressive. So let's see how this plays out. Back to you.
Okay, all right, Rima, thanks a lot for that. Well, for the time being, I think the markets are still under pressure. We'll slip into a short break. You come back, we'll chat with Mayuresh Joshi on a couple of stocks. Don't go anywhere. Welcome back. No signs really of a pullback, but the Nifty Bank, that has recovered close to under 150 points from the low point of the day. I think the bulls will take heart from that factor at least, that there is a bit of a bounce out there. In the mid-cap index, given that the Nifty is down 200 points, you have the mid-cap index is down only 0.2%, and a couple of these stocks are doing very, very well. Mayuresh Joshi joins us to help us out with some stock analysis. Hi, Mayuresh. Mayuresh, a couple of stocks are doing well. JK Tyre, you had a note coming in from DAM Capital earlier today, and they are quite positive on the stock. In an otherwise weak market, this one is bucking the trend. View on that?
Afternoon, Nigel. Interesting space because what is probably transpiring in terms of improved demand coming both from the OEM market, whether they are four-wheelers, two-wheelers, or even the CV space, seems to be intact at this point of time. And therefore, the offtake that probably happens, whether it's JK Tyre or Apollo Tyre to a large extent, is going to continue over the next few quarters with the slew of launches and the kind of deliveries that are expected to come through. The replacement market equally is holding up quite well. And therefore, I think the entire combination of the OEM and the replacement market expected to do well, augurs well in terms of the overall volume and value growth. Crude moving higher means derivative prices shall inch higher as we move ahead. And if it stays elevated, that's an outside risk for tire stocks because they might need to start building inventory, which might be, again, a little bit on the higher side. But the partial pass-through obviously happens through on the OEM side and the complete pass-through on the replacement side. So I think a lot of positives probably working in for these tire makers. Capacity is almost the kind of expansions that they've done largely in place. So I think no incremental additional capex that probably goes through for these companies, which means that the leverage levels on the debt equity side should probably top out in the coming few quarters and then start petering off as we move into the next financial year. So yeah, interesting space. Remain optimistic on JK Apollo.
Mayuresh, afternoon. Blue Star, that's gotten very excited with these QIP plans. They want to reduce their debt. They're using some money for expansion. Thoughts on Blue Star?
So this has, afternoon, Rima, this stock has stood out within the entire white goods, air conditioning, consumer durable space. And a large part of the capex that they've announced, I think the street probably likes both elements to this story. One, the debt portion that remains on their books can completely go off. And the incremental capex that can have a huge say in terms of addition that probably happens as far as the production numbers go, 300,000, almost 1.2 million odd. That becomes incrementally positive as this capex will go through. But a large element in terms of what has transpired on the balance sheet so far, they have gained market share over the past few quarters. Both their retail, which is the unitary cooling product side, and the industrial side has been holding up pretty well. With the kind of capex that we are seeing specifically in terms of the industrial corridors and the capex that are expected to come through the next few quarters in an incremental fashion, the B2B side, the enterprise side of the business should hold up pretty well with reasonable margins. And margins also expected to inch up as more and more operating leverage starts kicking in. So yeah, I think it's reacting on the news, but even on the balance sheet perspective, I think the numbers have been reasonable compared to its peers so far. Valuation a tad bit on the higher side. So anybody holding the stock can.
Mayuresh, internally at William O'Neill, is there a sense that we may be at the beginning of a slightly elongated sideways pullback kind of a market, or not really?
Afternoon, Prashant. Seems like because what we have in terms of our distribution day count for the Indian market seems a little bit elevated at this point of time. Though we have hit a confirmed uptrend back again because we just hit an all-time highs a few days back. What we are probably seeing for a few sectors is some elements of stalling coming through and a few leading stocks also indicating the same. And if this probably persists, you're absolutely right. I think this sideways consolidation phase can very well continue. The upside risk for the markets as we see it is how crude behaves, what probably happens in terms of the macro data points, specifically from global markets. And that can have a huge say in terms of how our markets behave. And if the distribution take count keeps on elevating with more stalling coming from more sectors, we'll turn cautious and careful on the business.
Okay. I think we've got about 2 minutes to go for close. So Just one name before we let you go, Mayuresh. Bombay Stock Exchange, BSE, it's a phenomenal run in September and before that as well, back at 1200. Any thoughts here?
So phenomenal move, Prashant. I think the entire domestic story in terms of flows, the kind of investors that are piling up as far as equity markets are concerned, you're seeing increased activity into the secondary markets, primary markets have also come back pretty sharply. So I think the annuity side of the business remains very, very strong. For players like BSE, the transaction side of the business, because of increased activity, remains equally strong as well. But I think the move has been too swift, too fast. So I think fast and furious for BSE as we see it, extended from key pivot levels. Therefore, no fresh additions at this point of time. We'll wait to
Okay, all right. We'll leave it there, Mayuresh. It's a pleasure as always. Thanks very much for joining us. So I think a day, 2 days more, and then we kind of see whether the market wants to treat the last 2 days, that is today and Monday, as a little bit of a temporary pause, and maybe the beginning of a slightly longer consolidation phase. We've not had one of those for so long now, so we'll see. We're down 220 points, 19,910. The level we put out was 19,914. So we are basically closing around that level. Bank Nifty comfortably above its own support levels, which we put out earlier. And I think we've got the mid and small cap part of the market, which did not deteriorate. Actually, towards close, the mid cap end of things picked up a little bit. So we are down about 0.25%. Small caps also picked up. When we started at 230, the index was down almost 1.25%. But there was almost 0.5% recovery in the small cap index in the last 60 minutes. We are down about 0.75%. Rima.
Today the markets were hit by a double whammy. HDFC Bank and Reliance Industries. HDFC Bank is the top Nifty loser, a cut of 4%, while Reliance Industries lower by 2.5%. Other notable drags include in JSW Steel, BPCL, Dr. Reddy's, Ultratech Cement, all these ending with cuts of nearly 2%. Fewer gainers, but it's the power-related stocks which stand out. So Power Grid, Coal India were the top 2 gainers. The mid-cap index ends with a cut of about 0.2%. The small-cap index fares a little worse. Small-cap index down 0.7%. The advanced decline ratio firmly in favor of the losing side, 1:2 by the close of trade. All in all, disappointing session. The Nifty holds on to 19,900 by the close of trade, but it's still a cut of more than 200 points on the Nifty, with the Sensex lower by 730 points. Out of time on closing bell. The show has ended. Thank you very much for watching.